While most investors are still fighting over overpriced property in Sydney and Melbourne, smart money is quietly moving elsewhere because right now there's a major shift happening in the Australian property market. And most retail investors are completely missing it. They're still chasing low yield capital city property, accepting weak cash flow, and hoping prices continue rising fast enough to justify the numbers. Institutional capital, developers, and logistic investment are increasingly moving into strategic regional hubs. And one market in particular keeps standing out in the data: Dubbo. Now, before people immediately dismiss Dubbo as just another regional town, I want you to stop thinking emotionally and start thinking structurally, because this isn't about hype. This isn't about chasing the next hotspot. And this isn't about buying somewhere because it's cheap. This is about following supply, demand, infrastructure, employment, and logistics. Because ultimately, that's what drives long-term property performance. And when you actually break down Dubbo, you start to understand why smart money is quietly positioning itself there. So in this video, I'm going to walk you through why Dubbo is outperforming many major markets, why rental demand remains extremely strong, why supply constraints are becoming more obvious, and why this inland logistics and infrastructure hub may be one of the most overlooked regional growth markets heading into 2026. Let's start with the broader misconception. Most people still think regional markets are risky, or that regional growth was just temporary because of the COVID trend. But the data increasingly suggests otherwise, because the strongest regional markets today aren't random mining towns or speculative tourism markets. They're economically diversified regional centers with infrastructure investment, employment growth, and strong migration drivers. And Dubbo fits that profile surprisingly well. Right now, Dubbo's median house price sits around $660,000. Now, compared to Sydney, that still sounds affordable, but affordability alone doesn't make a market attractive. The key question is, what are you getting in return for that entry price? And when you look at the numbers, Dubbo starts becoming very interesting. Over the last 12 months, house prices have increased by approximately 13.5%. Over 3 years, around 26%. And over 5 years, close to 68%. So this isn't a stagnant regional market. This is a market that has already demonstrated sustained growth over multiple timeframes. Now, looking at rental performance, rental growth over the last 12 months has been around 12%. That's well above what we'd normally expect in a balanced market. At the same time, gross rental yields are still sitting around 4.5 to 4.6%, which is materially stronger than many metropolitan markets. And this is where the disconnect starts appearing, because in many capital cities right now, investors are accepting low rental yields, high entry prices, and hoping future growth justifies the holding costs. But Dubbo is showing something different. You're getting strong rental demand, solid rental yields, tight supply, and established capital growth, all at the same time. Now let's look at supply, because this is where the market becomes even more interesting. At the moment, Dubbo only has around 1.13 months worth of stock on the market. That's extremely low. And when stock levels fall this far, buyers have fewer choices. Competition increases and price pressure builds. At the same time, days on market for houses have fallen from 42 days in April 2025 down to around 31 days today. That tells you something important. Demand is absorbing supply faster, and that's exactly what you want to see in a growth market. Now, layer in vacancy rates. Currently, Dubbo's vacancy rate is sitting at around 1.6%. That's relatively healthy and still quite tight. Now, importantly, this isn't a vacancy rate sitting near zero because there's no economic activity. It's being supported by employment and infrastructure expansion. And that distinction matters, because the long-term strength of any property market ultimately comes back to employment. People need jobs to sustain housing demand. And right now, Dubbo's unemployment rate is sitting at just 2.4%. That is extremely low. And when unemployment sits that low, it generally means businesses are competing for labor. Economic activity is strong and housing demand remains supported. Now, when you break down the industries supporting Dubbo, you can also see this isn't reliant on one single economic driver. The largest industries include agriculture, forestry and fishing, construction, and real estate related services. That diversification actually matters, because diversified economies tend to be more resilient over time. Now, another important factor here is public housing concentration. In Dubbo, public housing is relatively negligible at around 1.56%. And this is important because areas with lower concentration of public housing often see stronger owner-occupier appeal and greater long-term market stability. But the real story here is infrastructure and logistics, because this is the piece most investors completely overlook. Dubbo sits in a strategically important inland location within New South Wales. And increasingly, governments and businesses are investing heavily into inland freight, transport, logistics, logistics, and distribution corridors. Why? Because supply chain matters. Freight efficiency matters, and decentralizing logistics away from congested metropolitan markets is becoming more and more important. Now, this doesn't create overnight growth, but that's not how infrastructure works. What it does create is long-term economic support, more jobs, more movement of people, more business investment, more demand for housing. And once infrastructure investment starts compounding with population growth, that's where regional centers can begin outperforming expectations for long periods of time. Now, speaking of population growth, Dubbo's population is forecast to increase from around 55,500 people as of the census of 2021 to approximately 77,900 people by the year 2051. That's a substantial increase over time. And importantly, the main driver behind that growth is forecasted net migration. Now think about that carefully. People are expected to move into the region faster than natural population growth alone would suggest. And when migration increases, housing demand increases with it. Now another major signal here is development activity. In 2025, development application approvals increased by approximately 146% compared to the prior year. That's a significant jump. Now, on the surface, some people might look at that and say, well, that doesn't mean more supply is coming, potentially. But infrastructure-led regional markets often need increased approvals simply to keep pace with future demand. And importantly, approvals don't automatically equal completed housing stock, especially in an environment where construction costs remain elevated, trade shortages still exist, and building timelines continue to be stretched out. So even though approvals are increasing, that doesn't necessarily mean supply pressure disappears quickly. Now, stepping back from all this, there's a broader lesson here for investors. The best performing markets are rarely obvious at the beginning, because by the time everyone is talking about them, most of the easy growth has already occurred. And this is where many investors make mistakes. They follow headlines instead of fundamentals. They chase hype instead of supply-demand imbalances. And they buy emotionally instead of structurally. But when you actually look at markets like Dubbo through the lens of employment, infrastructure, logistics, migration, supply constraints, rental demand, and affordability, you start seeing why institutional and sophisticated investors increasingly look beyond the major capitals. Now, does that mean Dubbo is risk-free? Absolutely not. No market is. And regional markets can absolutely experience volatility. But the data today suggests this isn't simply a speculative regional spike. There are underlying structural drivers supporting the market. And that's the key difference. Now, personally, I think one of the biggest mistakes investors can make right now is assuming that capital city property is automatically safer or smarter. Because in many cases, the numbers simply don't stack up anymore. And while retail investors continue crowding into saturated metropolitan markets, regional hubs with strong infrastructure and logistics positioning may quietly continue outperforming. And while retail investors continue crowding into saturated metropolitan markets, regional hubs with strong infrastructure and logistics positioning may quietly continue outperforming. Now, whether Dubbo ultimately becomes one of the best performing regional markets over the next decade, we'll have to wait and see. But based on the current market fundamentals, it's very difficult to ignore what the data is showing. Now, if you want help understanding how to identify markets like this based on supply, demand, affordability, infrastructure, and long-term growth drivers, that's exactly what we help clients do. We build investment strategies around data and fundamentals, not hype. So if you'd like help putting together a clear property investment strategy, you can book in an initial strategy consultation using the link below. Otherwise, if you found this video valuable, make sure you like and subscribe, and I'll see you in the next video.